Good morning and welcome, everyone. I call this meeting of the NCUA Board to order. I must say, ladies and gentlemen, it is indeed an honor and privilege to serve on the NCUA Board. We, as NCUA board members, have been appointed by the President of the United States and confirmed by the Senate. We are all three here before you responsible for overseeing the safety and soundness of the country's credit union system and protecting the National Credit Union Share Insurance Fund. Our actions impact over 5,000 credit unions that serve over 117 million member owners. In discharging our duties that have been entrusted to us, we as board members must remain mindful that we are not exempt from the tenets and strictures of human decency, mutual respect, and professional courtesy. The first item on our agenda today is the 2019 mid-session budget. Staff presenting, Rendell Jones, Chief Financial Officer. Welcome.
Good morning, Chairman Hood, Board Member McWaters.
Good morning.
And Board Member Harper. I'm here today to present an overview of the 2019 mid-session budget and request the NCUA Board approve budgetary reprogrammings and other actions that I will explain during this briefing. We conducted the mid-session review annually to present revised budgetary estimates to the Board, taking into account spending for the first half of the year and updated requirements we recommend be addressed. The review is part of NCUA's commitment to financial transparency and accountability. For the 2019 mid-session, we have identified several items for Board consideration, all of which can be funded using amounts previously approved by the Board. I will describe these changes in more detail as I go through the presentation. Slide 2 outlines the specific topics I will discuss in this morning's presentation. I plan to briefly review and summarize the mid-session budget process, summarize spending in the operating budget for the first 6 months of 2019, including the estimated potential pay savings of $4.2 million, review updated requirements for the operating budget and updated priorities for the capital budget, present a summary of how I recommend the $4.2 million in pay savings be distributed to the operating and capital budget requirements, review changes to the Share Insurance Fund administrative budget, discuss a proposed name change and staffing level changes for one of NCUA's offices, and request the Board approve the recommended actions. In April of this year, my office sent out budget guidance to all NCUA office and regional directors, asking them to review, validate, and/or re-estimate how much they expect to spend for the year. This review applied to all three of the budgets approved by the NCUA Board for 2019. The 2019 operating budget of $304.4 million and 1,173 full-time equivalents, the 2019 capital budget of $22 million, and the Share Insurance Fund administrative budget of $8.4 million and 5 FTE. Once central and regional office submissions were received, my staff reviewed the revised budgetary estimates and assessed the reasonableness of the proposals and the submissions. We also assessed year-to-date staffing and hiring trends, as well as discussed recruitment plans with the Office of Human Resources. We compared this information to the pay and benefit budgets to determine whether there were variances between budgeted amounts and what we currently project spending for the year. In addition, we reviewed non-pay expenses such as travel, supplies, training, and contracted services to assess overall budget trends. This is where most of the input from the central and regional offices is particularly helpful. Our mid-session estimate for the operating budget is that pay and benefit spending for 2019 will be approximately $4.2 million below the board-approved budget of $304.4 million. The primary reason for the lower spending projection is because NCUA started 2019 with about 80 staff vacancies, which the Office of Human Resources has been working to fill. These vacant positions resulted in lower pay and benefit expenses for the first several months of 2019. As noted in the slide, the revised pay and benefit estimates are based on year-to-date changes in onboard staffing levels, which includes both hiring actions and separations. The estimates also assume that the agency headcount will reach the board-authorized staffing levels by the end of the year. Of the $4.2 million estimated in pay savings, approximately $600,000 was reprogrammed before this meeting to address revised budgetary needs, primarily the cost of employee relocations. The $600,000 was reprogrammed using delegated authorities and through board notation vote. Once accounting for this $600,000 already reprogrammed, approximately $3.6 million in pay savings remains for consideration. On slide 5, this slide shows how we propose to use the approximately $2.4 million of the estimated $3.6 million in pay savings. As you can see, there are 4 key areas where we propose using the funds. Now we'll review each one individually. The first item is employee relocations. NCUA pays to relocate employees who are competitively selected for a promotion or a new job within the agency that is in a different geographic area where they live. Employee relocations have increased in quantity and cost per employee in recent years, particularly in 2019. The larger number of employee relocations is partly the result of additional hiring and partly from the effect of the 2018 NCUA reorganization. The increase in per capita relocation costs is partly because of the change in the 2017 tax law that now treats all relocation reimbursements as direct compensation, taxable as income. Like other government agencies and private sector employers, NCUA reimburses employees not just for the relocation expenses, but also for the personal tax liability resulting from those payments. An additional $1.625 million is recommended for relocations in 2019. The second item is for legal services from outside counsel. The Office of General Counsel is currently working on a variety of complex regulations which requires consultations with additional legal experts, written products and reviews, and other regulatory support. The third item is for 2 requirements for the Asset Management and Assistance Center, or AMAC, in the Southern region. Approximately $90,000 is required to continue operating AMAC's servicing system in 2019 until a replacement is brought online. The AMAC servicing system is used to manage consumer accounts of failed credit unions that AMAC administers. Approximately $40,000 is required for additional facility support in the Austin, Texas office building that houses AMAC and the Southern Region office staff that NCUA owns. Combined, $132,000 is recommended for those requirements. The fourth item is a modest amount for miscellaneous contract training support and requirements identified in the past several months. After funding these items, $1.2 million of pay savings remains available, which we propose transferring to various capital projects that I will discuss in the next several slides. Slide 6 presents 3 high priority projects within the capital budget that require a total of approximately $2.7 million in 2019. Of that amount, we propose that approximately $1.2 million of the pay savings be allocated from the operating budget to the capital budget as I discussed on the previous slide, and that approximately $1.5 million be reprioritized within the capital budget to cover the remaining need. The first project, CU Online, will upgrade the system that NCUA uses to collect call report data from credit unions. The system is built on software that will no longer be supported by the vendor in 2020. Given the mission criticality of the system, we will use these funds to install technological improvements that will ensure its continued operation until such time as it's replaced. An additional $1.3 million is required for that project. The second priority project is updating of the Genesis and FORMIA systems, which is used to collect and analyze field of membership and other credit union information. Like CU Online, Genesis and the FORMIA systems are built on technology platforms no longer supported by the original vendor and must be upgraded to ensure its continued functionality and integration with NCUA systems until it's replaced. An additional $1 million was required for this item in 2019. The third priority project is the Examination and Supervision Solution, now more commonly called MERIT, which stands for Modern Examination and Risk Identification Tool. This system will replace ARIES, which credit union examiners use to conduct their examinations of credit unions. MERIT is scheduled for nationwide deployment next year, and an additional $410,000 is required this year to ensure development remains on schedule. On slide 7, as I mentioned when I discussed in the previous slide, there's approximately $1.5 million that is recommended for reprioritizing to fund the CU Online, Genesis Infomia, and Merit system requirements. Of the amount of the $1.5 million, approximately $900,000 comes from deferring two projects that were approved in the 2019 budget, while $645,000 comes from unspent budgets for projects approved in 2019 and 2018. The first project deferral is the NCUA Learning Management System, or LMS. The agency needs to acquire a new LMS at some point to better automate and track record keeping for employee development plans, training goals, online training, and other business needs. However, at this point, the LMS is stable and provides basic functionality for tracking employee training. In the 2019 budget, the board approved $550,000 for a new LMS, which is now recommended for reprogramming to the higher priority requirements I've discussed. The second reprioritization is for an analysis of alternatives for NCUA's financial management system. The financial management system we currently use, which is provided and managed by another federal agency, is cumbersome and does not include the functionality that more modern and effective solutions offer. Rather than reviewing alternatives to the current financial management system now, however, we will defer this review to a future year. The board approved $350,000 for the alternatives analysis in 2019, which is now recommended for reprogramming to the higher priority requirements. The remaining two items on the list, the Asset and Liability Management Application, or ALM, and the NCUA website redesign, are actually projects whose expenditures were less than planned when their budgets were originally developed. The 2019 contract award for ALM was approximately $345,000 less than approved by the board, less than the amount originally approved by the board, while the NCUA website was redesigned for approximately $300,000 less than approved in 2018. Slide 8 presents a tabular summary of the recommended 2019 budgetary changes that I've just reviewed. On the left, you can see that the $4.2 million in estimated pay savings and how approximately $600,000 of that amount was reprogrammed earlier this year, leaving $3.6 million available for revised needs. We propose to use this $3.6 million to fulfill $2.4 million in operating budget requirements and to transfer the residual $1.2 million to the capital budget, as shown by the arrow on the chart. Within the capital budget, the board is requested to reconsider reprioritizing approximately $1.5 million of previously approved project funding, combining that amount with the $1.2 million transferred from the operating budget. If the board approves, this would make available approximately $2.7 million for the higher priority capital technology projects in 2019. Slide 9 depicts the operating and capital budgets by cost category, comparing the original 2019 board-approved budgets to the revised amounts that would result from the approval of the mid-session reprogramming. The amounts in the change column shows the revisions I've just discussed, including the reprogrammings presented for consideration today. Next, on slide 10, I'll turn my remarks to the Share Insurance Fund Administrative Budget, or SIF budget. Projected 2019 budgetary obligations for pay and benefits in the SIF budget are expected to be about $162,000 higher than the board-approved levels. Based on contracts awarded earlier this year, however, support for the NCUA Guaranteed Notes program is estimated to be approximately $200,000 less than budgeted. These contract savings are proposed for reprogramming to the Share Insurance Fund pay and benefits line, reflecting our updated estimate for the actual cost for the 5 positions funded by the Share Insurance Fund. On slide 11, like I did for the operating budget, slide 11 presents a tabular summary of the changes to the Share Insurance Fund that I just discussed. Slide 12 presents one final set of items for board consideration related to the currently named Office of Public and Congressional Affairs, or PACA, as we call it. Because of the varied engagements carried out by the communications staff at NCUA, we believe that the office should be renamed to the Office of External Affairs and Communications. This new name change recognizes the office's engagement with our governmental and industry partners and reflects the entirety of the office's responsibilities. In addition, it is recommended that the board authorize 4 new staff positions for the office, the renamed office, including a deputy director, a communications specialist, a technical writer and editor, and a program analyst for external affairs. Additional descriptions of these positions is described in the board action memorandum. The proposed deputy director for the office will be at the senior staff position level 1. Slide 13 summarizes the recommended midsection actions for the board consistent with my presentation. The board action memorandum prepared for your consideration includes the following recommendation. It is recommended that the NCUA board approve the following actions. $2,425,000 reprogrammed within the operating budget from employee pay and benefits to administrative expenses and contracted services. $1,209,000 reprogrammed away from the operating budget, employee pay and benefits to the capital budget for higher priority projects. $1,545,000 reprogrammed within the capital budget from lower priority projects to higher priority projects, including $300,000 from the 2018 capital budget and $1,245,000 from the 2019 capital budget. $162,000 reprogrammed within the share insurance fund administrative budget from contracted services to employee pay and benefits, and rename the Office of Public and Congressional Affairs to the Office of External Affairs and Communications, and authorize 4 new staff positions, including 1 position at the senior staff position 1 level, making corresponding name changes to the NCUA regulations and delegations of authority. Please note, as explained in the board action memorandum, any rule amendments or delegation changes associated with the name change will happen in the near future, since these are technical revisions related to renaming the office. Slide 14 provides links to additional information and resources on the NCUA budget and lists the kinds of budgetary information available on NCUA's website. After the board action today, the website will be updated with any mid-session materials that include slide presentation and the summary of progress on each of the 2019 capital projects, detailed tables that present the impact of board-approved reprogramming on each office's budget. Slide 15 includes my contact information for any stakeholders who are interested in contacting me about this. Thank you for your time today. I'll be happy to answer questions.
Great. Thank you, Rendell, for your presentation of the updated estimates for the budget. I especially want to thank all of our NCUA staff who've all played a role in helping review our agency spending through the first half of the year. Today, the board is considering reprogramming existing agency funds, essentially recalibrating the 2019 budget approved by the NCUA board. The budget we are discussing today was originally adopted in November of 2018 after publishing the draft in the Federal Register, the public budget briefing where stakeholders were offered an opportunity to provide their views to the NCUA board, and NCUA's request for any additional written comments. As I mentioned to Rendell during a recent meeting in my office, it is critical that the NCUA is a responsible steward of the funds we collect from credit unions and any other resources entrusted to us. We must at all times hold ourselves to the highest standard, and we will continue to be transparent regarding our budget. As we look at the mid-year budget, I want to especially highlight that what is under consideration today allows the NCUA to make information technology investments that will not only help address the challenges highlighted in the presentation, but will also help both credit unions and the NCUA examiner workforce operate more efficiently. As we prepare soon for the 2020 budget, we will need to respond with innovation, integrity, and foresight, while at the same time recognizing that the resources we spend come from the credit union system. So we must be good stewards. I now just have a few quick questions. The presentation and the budgetary materials we produce on an annual basis, they really do reflect a high level of financial transparency that the NCUA practices within the financial regulatory community. I understand that NCUA is at the forefront of financial transparency with its budget. Rendell, can you please describe for me what our peer regulators do in this regard and our efforts to be transparent?
Sure. NCUA is the most transparent federal financial regulator in presenting budgetary information and program justification. So not only do we provide detailed materials on our website, we also publish a draft budget in the Federal Register and invite public comments, including holding a public briefing on the board, inviting the public, as you noted, to provide their views. And we've seen nothing similar either on input from the public or in written materials from any of our peers. And so the mid-session is, and the corresponding updates that I've described are our continued commitment in that regard.
Great, thank you. Another question I just have is that I understand that from your estimate that we have saved about $4.2 million in employee pay and benefits through the first half of the year. Do you anticipate any additional savings for the remainder of the year?
So the $4.2 million that I estimated assumes no additional pay and benefit savings for the remainder of the year. And as I mentioned, the Office of Human Resources is working diligently to fill vacancies through the offices and regions of NCUA. And not only that, we started the year, as I noted, at about 80 positions lower than authorized in the budget. Recruitment actions are out. People are conducting interviews, and we're making progress. But as is typical, we will continue to monitor and collaborate with the Office of Human Resources on that.
Great, thank you. I noticed that the agency is spending a bit more on employee relocations in 2019 than you previously estimated. And as you said, the number of relocations has increased. Can you give us a sense of what you're doing to manage these costs in the future?
Yes. So the Office of the Executive Director has been working diligently with regional and office directors, who are the hiring managers, to ensure that relocation expenses are only authorized when necessary. And so the Office of the Executive Director has implemented an additional review and approval process for relocation in an attempt to help curb costs. But due to the geographically dispersed nature of our staff, relocations really are a core part of the recruitment and vacancy filling practices for certain positions. In addition, we will continue to monitor relocation actions and evaluate further changes to ensure that we are working diligently to contain costs.
Great, thank you. And I do just have one final question. I understand that we will defer development of 2 IT projects until future years, the learning management system and the financial management system analysis of alternatives. Do you have any concerns about the impact on the agency's ability to manage these important support functions, or funding for these projects have to be included in future budgets?
So it's important to mention these 2 projects. I'm not overly concerned about the risks of deferring these projects. Both the learning management system and the financial management system are currently stable and functional, but they were both developed for business processes and requirements that have evolved and matured over the years. And so our current learning management system and accounting system do not meet some of our current business needs, and agency operations could be improved by those replacements. So I would expect to see a request from staff to the NCUA board for consideration in future years for both of those.
Very well, thank you. I have no further questions. Board Member Harper.
Thank you, Chairman Hood, and many thanks to you, Rendell, and your team, as well as the team in the Executive Director's Office for your good work on these 2019 budget modifications. I appreciated your briefing today, and I will be supporting the proposal as it reflects prudent investments in the agency's employees and infrastructure. In particular, I want to underscore my support for the agency's efforts to increase transparency and allocate the resources needed to effectively execute our mission in a transparent and thorough manner. I also have one question related to the reallocation of $600,000 for legal services. Rendell, would you provide me with some greater detail about what those expert needs are?
Sure. So these funds will be used to contract for specialized legal services and expertise that NCUA does not have in sufficient quantity in-house. So over the last few years, the Office of General Counsel has determined that it's in NCUA's best interest to retain outside counsel for assistance in specialized capital markets matters, such as subordinated debt rulemaking, including the securities laws related thereto, and for asset securitization areas. So we expect to continue to require such services for the remainder of the year and into the future.
So the money is needed to help us meet our priority goal of getting through with a subordinated debt proposal.
That is correct.
And that's something that I do support the chairman on. Thank you for that information. I look forward to the discussions that we will have at the upcoming budget hearing in October and the November board meeting. In my view, it is very important that we ensure that we have sufficient staff and funding for the NCUA to complete its core responsibilities of protecting safety and soundness and protecting consumers. Thank you, Rendell.
Thank you.
Thank you. Board Member McWaters.
Thank you, Mr. Chairman. Rendell, could we go to slide 8? If you look at that slide, I mean, maybe I'm channeling my inner accountant here or something, but under operating budget, there's a $3.6 million that says available for mid-session operating budget. Then you go to the right-hand side under capital budget. It says 1.5 million available to reallocate from lower priority projects, estimated savings. You add those two together, you get 5.1, and that is used to fund the 2.4 proposed for updating operating budget requirements, and also to fund the 2.7 proposed for updated capital priorities. So the math works, the accounting works, the sources equal the uses. But on the sources side, you said a moment ago that we're continuing to hire employees and the like. So my only point is of the $4.2 million in savings that we're using as a source here, and of the 1.5 million under capital budget, which is available to reallocate, another source item, that some of that money is temporary. It's a timing difference, isn't it?
That is correct.
I mean, as we hire in new people, a part of that 4.2 would actually be less, but right now we can use it. But in the future, we're going to have to fund more to hire those employees, correct?
That is correct.
And also, those projects that have been bumped to a lower priority, the ones that we consider to be appropriate to go forward with, we're going to have to fund those from some source.
Correct.
Okay, thank you. That's all I have.
Great. Thank you. Is there a motion?
Yes, there is. There's a lengthy motion.
Very much so.
I'm glad you get to deliver
Okay,
it.
here I go. I move that the board approve reprogramming $2,425,000 within the operating budget from employee pay benefits to administrative expenses and contracted services. 2, reprogramming $1,209,000 away from the operating budget, employee pay and benefits to the capital budget for high priority projects. Number 3, reprogramming $1,545,000 within the capital budget from low priority projects to higher priority projects, including $300,000 from the 2018 capital budget and $1,245,000 from the 2019 capital budget. 4, reprogramming $162,000 within the Share Insurance Fund administrative budget from contracted services to employee pay and benefits. And 5, renaming the Office of Public and Congressional Affairs to the Office of External Affairs and Communications, and authorizing 4 new staff positions, including 1 position at the SSP 1 level. In addition, making corresponding name changes in NCUA regulations and delegations of authority, all as detailed in the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
All opposed, nay. The ayes have it, and let the record show the motion passed 3-0. Thank you, Rendell. The second item on our agenda today is Final Rule, Parts 704 and 713, Fidelity Bonds. Staff presenting Ian Marina, Associate General Counsel, and Rachel Ackerman, Staff Attorney, Office of General Counsel. Welcome.
Good morning, Chairman Hood, Board Members McWaters and Harper. I'm here to request board approval of a final rule to amend the NCUA's Fidelity Bond regulations. The board issued a proposed rule for comment in November and received 26 comment letters. In general, many of the commenters supported the stated goal, but all had concerns about specific aspects of the proposed rule. Most of those concerns related to the cost. In response to the commenters, several changes were made to the final rule. I'll discuss those changes as I walk through the final rule. The first objective of the final rule is to strengthen a board of directors' oversight of a credit union's fidelity bond coverage. Currently, the rules require a credit union's board to annually review its fidelity bond coverage. Under the final rule, a credit union's board would review all applications for purchase and renewal and will vote on a resolution approving those purchases or renewal. The board will then delegate 1 board member who's not an employee of the credit union to sign the purchase or renewal. That board member couldn't sign for consecutive years. This policy is intended to address concerns we've had with rescinded fidelity bond coverage. In the past, the NCUA has had incidences of fidelity bond coverage being avoided if the signatory was knowledgeable of fraudulent activity. In the case where the NCUA is the liquidating agent, the Share Insurance Fund has suffered losses. We believe it is less likely that a non-employee board member would also be the one perpetuating the fraud, and therefore the chances of bond being voided are also reduced. Here, we've made one change to the final rule as compared to the proposed rule. Under the proposed rule, in addition to the board of directors annually reviewing the purchase and renewal, the supervisory committee also reviewed the purchase or renewal. Under the final rule, it'll just be the board members who review the purchase and renewal. The second objective of the final rule is to ensure an adequate period to discover and file Fidelity bond claims following a credit union's liquidation. Currently, most Fidelity bond forms provide that the bond's coverage terminates upon liquidation, but it doesn't provide an express period of time for the NCUA as the liquidating agent to discover and file a claim. In such a case, there's a chance that the NCUA wouldn't be able to file a claim and the share insurance fund would suffer losses. Instead, this final rule would ensure that the NCUA and the liquidating agent has an explicit right to extend the discovery period, which should prevent losses to the insurance fund. For involuntary liquidations, the period in the final rule is 1 year. For voluntary liquidations, that period is 4 months. Here again, this is another place where we've modified the proposed rule in response to commenters. In the proposed rule, the period for involuntary liquidations was 2 years, but in the final year, that period has been reduced to 1 year. The third objective of the final rule is to codify a 2017 NCUA Office of General Counsel legal opinion that permits a natural person's credit union's fidelity bond to include coverage for certain CUSOs. Currently, Part 713 states that a bond must be purchased in an individual policy. An OGC had previously interpreted that to preclude a credit union's CUSO. Under the final rule, a fidelity bond would be permitted to cover a CUSO in certain instances. Permissible CUSOs would include one in which a credit union owns greater than 50% of the CUSO, or if a CUSO is organized for the purposes of handling certain business transactions and composed exclusively of a credit union's employees. We didn't make any changes in this section in response to comments. Finally, the rule modifies the board's approval of bond forms. The final rule clarifies which bond forms require board approval and makes clear that any document that limits coverage also requires board approval. The final rule also sets the NCUA board approval on all bond forms 10 years after a bond form is approved. Again, due to comments, the rule has been modified. Additional flexibility has been incorporated into the final rule in 2 areas. The board is now permitted to waive the 10-year sunset period, and we've clarified that the sunset date is always 10 years after the board has approved the bond form. I'd be happy to answer any questions now.
Great, thank you. I have a few comments and then I too have a few questions. This is really an important final rule to update and strengthen the NCUA's fidelity bond requirements. Fidelity bonds insure a credit union from losses related to fraud. Without adequate fidelity bond coverage, any losses from fraudulent transactions are absorbed by either the credit union or, in the case of a liquidated credit union, the share insurance fund. We have a responsibility mandated under federal law to minimize losses to the National Credit Union Share Insurance Fund, which protects over 117 million member owners. I believe that this final rule will address concerns we've seen in the fidelity bond market while ensuring both credit unions and the Share Insurance Fund are adequately protected against fraudulent losses. One of the most important provisions of the final rule will require a credit union's board of directors to review all applications for purchase or renewal of bond coverage and to pass a board resolution approving the purchase or renewal. This requirement has been added to the final rule to address concerns related to the rescission of fidelity bonds. In recent years, the Share Insurance Fund has lost over $10 million when fidelity bonds were voided because the signatory of the bond was also the perpetrator of the fraudulent actions. This modest increase in board involvement to the fidelity bond process will provide meaningful risk protection to the Share Insurance Fund. Also, the final rule ensures an adequate period to discover and file fidelity bond claims following a credit union's liquidation. In recent years, the NCUA has faced difficulties extending the period necessary to discover and file claims after a credit union has been liquidated. A reasonable period to discover claims will help prevent the Share Insurance Fund from suffering unnecessary losses. As a matter of regulatory relief, the final rule would codify a 2017 NCUA Office of General Counsel legal opinion that permits a natural person credit union's fidelity bond to include coverage for certain credit union service organizations, also known as QSOs. I now just have a few quick questions. Does the Federal Credit Union Act require credit unions to have fidelity bond coverage?
Yes, it does. Coverage is statutory, and credit unions are required to have coverage, and it's also statutory that the NCUA approve bond forms.
Thank you. And the provisions in the final rule are in response to concerns that the NCUA has with some recent developments in the fidelity bond industry. Would you characterize those provisions as general changes throughout the rule, or are they focused on concerns that have arisen from industry practices?
The changes are intended to be targeted, and they're in response to demonstrated losses that we've seen in the fidelity bond market. Other fundamental elements of the rule remain unchanged. For example, the amount of fidelity bond coverage has been unchanged.
Great, thank you. And one final question. Some of the comment letters that we received express, I get a bit of concern about the cost. Do you expect substantial, or at least a substantial increase in cost for credit unions through this rule?
No, and we made several changes to the rule in response to commoners' concerns about costs as well, and we believe this will reduce the potential for increased costs and burden. We also had discussions with industry stakeholders and do not believe the rule will cause a substantial increase in cost to credit unions.
Great, thank you, Rachel. I have no further questions. Board Member Harper.
Thank you, Mr. Chairman, and welcome to the table, Ian and Rachel. It's good to have you here. You've made a topic that is incredibly dull quite interesting, and I want to thank you for that, also for your briefings and getting us prepared for today. This final rule to strengthen the NCUA's regulation of fidelity bonds carefully balances our fiduciary responsibility to protect credit unions, their members, and the Share Insurance Fund from fraud with our desire to provide regulatory relief to credit unions. The final rule also demonstrates that we listened carefully to the comments made on the proposed rule and made appropriate adjustments to minimize the rule's impact. Most importantly, in my view, it protects credit unions, their members, and the Share Insurance Fund by requiring annual reviews and approval by the Board of Directors of a credit union's fidelity bond coverage, and by requiring a member of the board who is not an employee to sign purchase and renewal agreements. In order to minimize the possibility that the signer was a party to or aware of fraudulent activity, the rule also requires that no board member may be the signatory in 2 consecutive years. As the chairman noted just a short time ago, we have had instances where the Share Insurance Fund has lost millions of dollars because the signer was a party to or aware of the fraud, allowing the insurance company to repudiate the bond. Over the last decade, insurers have repudiated more than $10 million of fidelity bond coverage due to the signatory being aware of fraudulent activity. Ultimately, these are the losses that the Share Insurance Fund, and by extension the members of all other federally insured credit unions, had to bear. While this amount doesn't represent a material threat to the Share Insurance Fund, our fiduciary responsibility doesn't permit us to ignore the loss. Another major feature of the final rule is that it requires credit unions to obtain policies that allow the liquidating agent to purchase coverage to extend a bond for 1 year after liquidation. This change extends the discovery period to give NCUA the time after the fraud is initially discovered to produce evidence and file a claim. The proposed rule would have extended the discovery period by 2 years, which many commenters felt was too long, and I think you noted that in your comments. The final rule, in my opinion, reasonably balances competing needs without extinguishing the NCUA's ability to recover funds for the Share Insurance Fund. The final rule also minimizes regulatory burden by removing a provision from the proposed rule that required a credit union supervisory committee, as well as its board, to review all applications for purchase or renewal of fidelity bond coverage. Only a single review will be required now. For credit unions, in addition to lengthening the review period for bond forms, the final rule also allows a natural person credit union to include coverage in its fidelity bond for certain QSOs, thus reducing the cost of fidelity bond coverage for the combined entity. I commend staff for diligently reviewing comments submitted on the proposed rule and finding solutions that appropriately balance our need to protect the Share Insurance Fund, other credit unions, and their members from fraud, with our desire to provide additional regulatory relief for credit unions. But before I close, I do have one question for staff. And Ian, perhaps you may be the better one to answer this question. The NCUA has announced that it will follow the spirit of the April 11th memorandum from the Office of Management and Budget about the Congressional Review Act. Was this rule submitted to the OMB in advance of our vote today? And if so, what was the determination?
Yes, sir. It was submitted to the OMB, and the rule was determined to be not major.
Thank you. Congress created the NCUA as an independent agency, and we should work to protect that independence. As a result, I do have concerns about the OMB making its determination in advance of the vote by the NCUA board. In my view, a determination should occur after, not before, the vote, and I am worried that OMB involvement in our ongoing decision-making activities could one day insert politics into the regulatory process and undermine our independence. Nevertheless, the final rule before us today is a good one, and I will vote in favor of the motion.
Great. Thank you, Mr. Harper. I would just like to quickly address an issue you just raised. Our general counsel recommended that we comply with the spirit of that memo from OMB, and I've decided to implement that recommendation. Our efforts are consistent with most of the other FIREA agencies. This is just for us a simply good government practice, and it's not affected the agency's rulemaking or guidance.
And Chairman, I appreciate that. And my question is not whether OMB can do this, it's just the timing of it, really.
Okay, good, thank you. And board members, Waters, you are recognized.
Thank you, sir. I have no comments other than to say on the substance of this proposal, I agree with your comments, Mr. Chairman. I agree with your comments, Mr. Harper. And I have no questions.
Great, where's there a motion?
Absolutely. I move that the board approve final rule parts 704 and 713 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
The ayes have it, and let the record show the motion passed 3-0. Thank you, Rachel and Ian. The third item on our agenda today is proposed interpretive rules and policy statement guidance regarding prohibitions imposed by Section 205D, which is also known as the Second Chances IRPs. Staff presenting Pamela Yu, Special Counsel to the General Counsel. Welcome and good morning.
Good morning. Thank you. Today I'm presenting for the board's consideration proposed interpretive ruling and policy statement 19-1, or, as you mentioned, Second Chances IRPs. Section 205D of the Federal Credit Union Act prohibits, except with the prior written consent of the board, any person who has been convicted of any criminal offense involving dishonesty or breach of trust, or has entered into a pretrial diversion or similar program in connection with prosecution for such offense, for participating in the affairs of an insured credit union. In August 2008, the board issued final IRPs 08-1 to provide direction and guidance to federally insured credit unions and those persons who may be affected by Section 205D because of a prior criminal conviction, by describing the actions that are prohibited under the statute and establishing the procedures for applying for board consent on a case-by-case basis. The IRPs has not been revised since 2008, and based on our experience with the IRPs over the past decade, we are now proposing to update and revise the guidance to reduce regulatory burdens. Recognizing that certain offenses are so minor and occurred so far in the past as to not currently present a substantial risk to the insured credit union, IRPs 08-1 currently excludes certain de minimis offenses from the need to obtain consent from the board. However, several recent applications requesting the board's consent pursuant to Section 205D involved fairly minor, low risk, and isolated offenses that did not fall within the current de minimis exception. In light of these recent cases, the substantial passage of time since IRPs 08-1 was adopted, and importantly, the agency's commitment to opening a path forward for those seeking redemption for past criminal activities, it's appropriate to now consider expanding the exceptions to the Section 205D employment restrictions. The Second Chance IRPs would amend and expand the current de minimis exception to reduce the scope and number of offenses that would require an application to the board. Specifically, the proposed IRPs would not require an application for offenses involving insufficient funds checks of aggregate moderate value, small dollar simple theft, false identification, simple drug possession, and isolated minor offenses committed by covered persons as young adults. The proposed IRPs would also make some grammatical formatting and clarifying changes. The Second Chance IRPs supersede and replace current IRPs 08-1 and will reduce regulatory burden while protecting federally insured credit unions from risk by convicted persons. I am happy to answer your questions.
Great, thank you. And I'd like to thank all of our staff who've actually worked on the IRPs, or better known now as the Second Chances IRPs. The IRPs would provide much needed regulatory relief by expanding the exceptions to the employment restrictions under Section 205D of the Federal Credit Union Act, thereby reducing the number of applications that will have to come before this board for our consent. The value of lost output of people with criminal records who have difficulty finding employment is estimated at between $78 billion and $87 billion. These numbers represent a significant drain on our economy, resulting in vast underemployment and unemployment. The vast majority of Americans with some kind of criminal record are not violent or career criminals who pose no risk to society, but people who perhaps have made a bad decision in their youth and have since turned around their lives to become productive citizens. I have often heard it said that forgiveness is less about changing the past than it is about changing the future. And this rulemaking today before us keeps what America's shared, the values of forgiveness and redemption. A great many of the individuals impacted by this rule could be a significant potential economic resource, yet they face hiring barriers due to their checkered past. Looking for ways to expand career opportunities for those who have paid their debt to society is simply the right thing to do. But it could also be, but in addition, it could be a boon to credit unions in a tight labor market. This is an important conversation and a tremendous opportunity for the financial services industry. In closing, I am just gratified to see NCUA making significant progress in this area early in my tenure as chairman. I do have a few quick questions. I've heard that some of the credit unions support second chances, but are a little concerned that there could be an increase in insurance. Is this a reasonable concern, or is it unfounded?
I think we can look forward to the public comments on that to give us a better idea of those types of impacts that this may have. Certainly, I think credit unions can talk to their Fidelity bond providers and get a better understanding of the cost impact of employing individuals that perhaps pose higher risk due to their criminal background. But at this point, we don't anticipate that the proposal should have any significant impact on the cost of bond.
Great, thank you. I'll look forward to those comments too. Now, the FDIC has a similar statutory prohibition in Section 19 of the Federal Depository Insurance Act. Does the FDIC have similar exceptions to their employment ban?
They do. So as you mentioned, Section 19 of the Federal Deposit Insurance Act does contain a prohibition that's parallel to ours, Section 205D. The FDIC has adopted a statement of policy regarding its Section 19 prohibition, and it's modified and updated its guidance over time, most recently in 2018. In the past, we have been mindful of their guidance, and again, with this proposed IRPs, we do believe it's beneficial to both institutions and covered individuals to have some consistency between our guidance and FDIC's. So the changes are large. The changes in this proposed IRPs are largely in line with the FDIC's changes.
Great. And I have one final question, Pamela, and that is, in the past few years, we've approved several consent applications which involved fairly low-risk, isolated offenses that did not fall within the current de minimis exception. Would the proposal's expansion to the exception help avoid the need for a consent application in those types of cases?
Yes, I think so. So historically, consent applications are relatively rare. We don't get a large number year to year, but many of them in the past have involved low-risk offenses such as small dollar shoplifting or petty theft. Often these offenses occurred when an individual was a young adult or even a minor. However, because the potential punishment for these offenses did not meet the de minimis standard, consent application was required to be heard. Under the second chances IRPs, however, the new expansions to the de minimis exceptions should eliminate the need for applications in the bulk of these types of cases. The proposed IRPs includes an exception for simple theft of goods and services under $500 and a new age-based exception to the filing requirement as well. And those provisions in particular should help to reduce the number of these types of cases that have to come forward.
Great, thank you. I have no further questions. Board Member Harper.
Thank you, Pamela, for your presentation, and thank you, Chairman Hood, for focusing the agency's attention on inclusion and targeted regulatory relief. I especially liked your comment today about forgiveness being part of the future. That was a very good point. Inclusion, as you know, is also one of my priorities. So I applaud your efforts and support proposing an update for the Second Chances Interpretive Ruling and Policy Statement. Creating second chances for individuals who may have made a poor choice and paid the price is, as the chairman notes, the right thing to do. It's also important that we can do this and provide regulatory relief for credit unions. As Pamela laid out, the Second Chances Interpretive Ruling and Policy Statement has not been revised since 2008, and I agree that an update is warranted at this time, especially as the FDIC has recently acted on this matter. Pamela, I have two questions for you. First, would you please clarify for me the types of employees that would be covered under this proposal? Are we talking about the gardeners and the custodians, or are we talking potentially about the tellers and the loan officers?
We're talking about the tellers and the loan officers. We're talking about people who are participating in the conduct of the affairs of the credit union.
Great, thank you. Individuals who have paid their price deserve to have the chance to get on with their lives in order to be included as productive members of society. My second question is, if this proposed rule is finalized, approximately how many applications would we not have to come before the board for us to view?
Looking at our past consent to work orders, I think we can approximate that roughly a third of those applications would have found relief or been unnecessary under the second chances verbs. So a rough estimate of approximately a third.
Roughly a third. And what was that, 2, 3, 4, 6 applications a year, 10?
I would say on average, we've had probably 3 to 5
Great.
applications.
Fantastic. Thank you. That is targeted regulatory relief, and it certainly eases the work on the board, and for that I am appreciative. I encourage anyone who has an interest in this proposal to provide comments during the 60-day comment period. I will support the proposal when we vote on it shortly.
Great, thank you. Board Member McWaters.
Thank you. Thank you. Yeah, over the last few years, I have faced a number of these presentations, and they all sort of take your breath away that someone makes generally youthful indiscretion or just a prior indiscretion, and they turn their lives around dramatically. In a lot of cases, 10, 20 years go by, but they're still haunted by what they did when they were 17 years old or 27 years old. And that, to me, is wrong. We should not be imposing what I would say, in effect, is a financial death penalty on people. Is just redlining them away from working in the financial services area if they meet the criteria laid forth and laid out in this proposed rule. Surely, the NCUA, we can balance our safety and soundness obligation with a sense of compassion that underlies the second chances and look at people as who they are today and the way they have built their lives into the person they are today, where they're not constantly burdened by the shadow of their youth. So I very much support this. One thing I'll just say with respect to this OMB business, some of you may not be familiar with that, but from my perspective, this is an administrative undertaking, a procedural undertaking. There's something called the Congressional Review Act, which was passed by Congress, signed by the president. So this is not an executive order. The Congressional Review Act is out there. And what the Congressional Review Act says, under certain circumstances, Congress can say, hey, nice try, NCUA, or nice try to any body. We're going to overturn you. We're going to overturn your rule that you implemented. In other words, Congress has the ultimate authority. What this OMB rule in effect says is we need to make certain determinations, whether it's a minor rule or a major rule. And by sending it there and making our recommendation, whether they agree or they concur, if it's major, then chances are it can be reviewed for CRA, Congressional Review Act action. So yes, we are an independent agency, but in my view, I do not consider this burdensome on us. Thank you.
And if I may, just for a quick second, again, my issue is not with OMB making the determination. It's just, in my view, it should come after the board action, and that would be a better protection for our independence. Reasonable people can agree to disagree on some issues, and again, mine is timing. I certainly appreciate your points.
Okay, thank you.
Is there a motion on the IRPs?
I move that the board approve proposed interpretive rule and policy statement 19-1 for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All in favor say aye.
Aye.
The ayes have it, and let the record show the motion passed unanimously, 3-0. Thank you, Pamela.
Thank you.
Again, I believe this is a positive first step, but I believe the NCUA and the financial institutions must do even more in leading the way forward to expand career opportunities for those who have paid their debt to society. This, as many of you know, is indeed a priority of mine, and I am grateful that the NCUA board is in lockstep agreement on this issue. I look forward to the NCUA doing more and leading on second chances. In fact, now that the board has voted, I look forward to now broadening the ecosystem of those who are working with second chance, meaning looking at housing, looking at also financial institutions, not just us hiring them, but also many of these individuals face barriers to having access to mainstream economic activities. They also have difficulty accessing housing. So expect more coming from this agency as it relates to building a strong, viable ecosystem for second chance individuals. With that being said, the final item on our agenda today is Final Rule Part 722, Real Estate Appraisals. Staff presenting Larry Fazio, Director, Lou Pam, Senior Credit Specialist, and welcome back Rachel Ackerman, Staff Attorney, Office of General Counsel. Well, all of you are welcome, but she gets double duty today.
Thank you, and good morning, Chairman Hood, Board Member McWaters, and Board Member Harper.
Good morning. Good morning.
Staff Attorney Rachel Ackman, Senior Credit Specialist Lou Pham, and I are here to request the Board approve the final rule, Part 722 of NCUA's Rules and Regulations regarding appraisals. Rachel's going to give us some background now on legislative and regulatory history in this area for appraisal.
In 1989, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act, or FIREA. Title 11 of FIREA directs each regulatory agency to prescribe standards for real estate appraisals in connection with federally related transactions under its jurisdiction. Under FIREA, federally related transactions are defined as those real estate related financial transactions where an agency requires the services of an appraiser. Title 11 requires that appraisals for federally related transactions be performed in accordance with uniform standards. However, each federal regulatory agency has some discretion to establish requirements for when an appraisal is necessary. FIREA authorizes agencies to set threshold levels at which no appraisal is required. I would also note that as required by the Dodd-Frank Act, we have received concurrence from the CFPB that the revised threshold provides reasonable protection for consumers who purchase 1 to 4 unit single-family residences. In 2018, Congress passed S. 2155, or the Economic Growth, Regulatory Relief, and Consumer Protection Act. S. 2155 exempts from the NCUA's appraisal requirements certain federally related transactions involving real estate located in a rural area with their transaction value below $400,000 and where no state certified or state licensed appraiser is reasonably available. The other banking agencies revised their appraisal rules in April 2018 to increase the appraisal threshold requirement for certain commercial real estate transactions from $250,000 to $500,000. The banking agencies now have 3 separate thresholds: $250,000 for residential real estate transactions, $1 million for qualifying business loans, which has been at this level since 1994, and $500,000 for other commercial real estate transactions that are not qualifying business loans, which was just increased in April 2018. A qualifying business loan, or QBL, is a business loan that is not dependent on the sale of or rental income derived from real estate as the primary source of repayment. The NCUA has not revised the Part 722 regulatory threshold since 2002 and has never had the commercial distinction between QBLs and non-QBLs that the banking agencies adopted in 1994. Largely because the other banking agencies' appraisal threshold changes, the NCUA proposed to update our appraisal threshold with a notice of proposed rulemaking in September 2018 to increase the commercial real estate threshold from $250,000 to $1 million. Based on public comments on the proposal, we have made one substantive modification to the proposed rule. The final rule will not adopt the proposed gap definition of a new loan for the exemption of existing extensions of credit. Instead, we will continue to use the current exemption for existing extensions of credit. Now I will turn it over to Larry to discuss the objectives.
Thank you, Rachel. So as we did this rule, we set out to achieve 4 objectives. The primary objective is to update the appraisal standards for credit unions to reflect changes in bank standards since the appraisal for the agency was last increased 17 years ago. As noted earlier, banks have had a $1 million threshold for QBL since 1994 and $500,000 for non-QBL since April of last year. With this rule, we will ensure that, all else being equal, a credit union will not be at a disadvantage for commercial real estate lending. I would also note that commercial real estate prices have risen by over 100% since the threshold was last increased in 2002. Thus, an increase in the appraisal threshold to over $500,000 is warranted on that basis alone. We also believe the increased threshold will provide some measure of relief for credit unions and their borrowers in rural areas where there may be a shortage of certified appraisers. The second objective is to restructure Section 722.3 of the rule to more clearly indicate for the reader when a written estimate of market value, an appraisal conducted by a state licensed appraiser, or an appraisal conducted by a state certified appraiser is required for real estate related financial transactions. Third objective is to incorporate the rule exemption in S2155, as Rachel mentioned, into the regulation itself so that all of the appraisal requirements are located in one place for ease of use by the reader. And then finally, we made some various other minor conforming adjustments, primarily to the definitions. So in a nutshell, what's really changed is reflected here on slide 5 in terms of the substance. That's raising the commercial real estate appraisal threshold from $250,000 to $1 million. So you can see that in the middle column where we're comparing the current rule to which is the first substantive column, to the middle column, which is the final rule. And then the final column is the comparison to the other banking agency rule. And so our change goes going from $250,000 to $1 million is reflected there. It would no longer require an appraisal by a certified appraiser. It will, however, still require, those transactions will still require a written estimate of value. With that, I would also mention that, as Rachel had indicated, we chose not to make a distinction between a QBL and a non-QBL like the banking agencies do. You see that reflected in the $500,000 to $1 million line in the last column. We think that added complexity to the rule wasn't necessary in our case, and we're going to go through a good discussion here in a second with Lou on how we arrived at that determination, what considerations we took into account. With that, I'm going to turn it over to you.
We took various factors into consideration when developing this rule. First and foremost, a commercial loan is repaid from the cash flow of the business, which ultimately depends on the success of the business model. Other than raising the appraisal threshold to $1 million, the final rule will not change the expectation that credit unions manage their lending and credit operations in a safe and sound manner. Part 723 of NCUA regulations regarding member business loans and commercial loans, which includes commercial real estate loans, requires board and management oversight of a credit union's business lending practice. As part of this management and oversight responsibility, a credit union must establish and adhere to a commercial loan policy. An effective commercial loan policy provides a credit union parameters for prudent lending. Chief among the many criteria for commercial loan policy is that credit unions are required to establish underwriting standards to reasonably determine a borrower's ability to meet its debt service obligations, which is contingent on its ability to generate cash flow. Credit unions must also have a collateral policy to ensure risk sharing with borrowers and mitigate loan losses by establishing lending limits based on the value of the property. In short, our regulations and safe and sound lending practices dictate that for credit decisions and to determine the success of a loan, credit unions must primarily focus on the borrower's cash flow and ability to service debt, not on the value of the collateral. Even though the appraisal threshold will be raised to $1 million, credit unions have always been and continue to be required to obtain written estimates of market value for transactions below the threshold. Written estimates of market value can be less expensive and quicker to produce than an appraisal, but still provide a reasonable basis for valuing real estate, especially given recent advancements in technology and market transparency in the real estate market. A safe and sound written estimate of market value is one that produces a reliable estimate of a property's market value, contains sufficient information and analysis to support the credit union's lending decision, and is conducted by a person that is qualified and independent of the transaction and whose work is reviewed for adequacy. With this final rule, we have enhanced standards for individuals performing written estimates of market value by codifying into the rule text requirements for that person to be independent, not only from the transaction, but also from the loan production and collection process. We also clarified that written estimates of market value need to have a physical inspection element to increase transaction integrity and support a property's value. The final rule does not require appraisals for commercial real estate transactions under $1 million. However, credit unions must exercise their judgment based on safe and sound banking practices in determining whether an appraisal is warranted, even if not required, based on specific risks for the transaction. We would also point out that most credit unions that engage in commercial real estate lending have had a successful history and performed well during the last recession. Unlike the other banking agencies, NCUA has never made a distinction between QBLs and non-QBLs. Our commercial threshold applies to all commercial real estate transactions. In our view, QBLs and non-QBLs have separate and distinct risks, but one is not necessarily higher risk than the other. Because QBLs are not dependent on the sale or rental income of a property as a primary source of repayment, they are much more dependent on the operating business's success and can have more unique physical features that may impact their saleability and hence liquidity in a default situation. Non-QBLs are often rental properties, such as apartment buildings, where financial information is more transparent and with a larger pool of potential buyers. However, they can be more exposed to real estate market cycles. Thus, we do not believe it is worthwhile to adopt this distinction in the appraisal rule. Compared to banks, credit unions in general have relatively low exposure to commercial real estate. Commercial real estate as a whole only makes up 4% of credit union assets, and this level has been relatively stable over recent history. Having said that, there's a small number of credit unions that individually have higher concentrations of commercial real estate relative to their asset size and capital. We will address any risk these institutions pose as part of our new credit concentration risk examination and supervision procedures that will be put in place by the end of the year. The call report does not collect data on individual commercial real estate loans. However, we use data from CoStar, a leading commercial real estate information provider, to help us estimate the impact of this rule change. We estimate that raising the threshold to $1 million could exempt an additional 39% of transactions from appraisal requirements, with cumulative exempted transactions of 66%. However, in terms of dollar volume, we estimate only about 13% of commercial real estate loans would be exempt from the requirement to have an appraisal conducted by a certified appraiser. We would also note that about 28% of credit union commercial real estate loans likely would meet the definition of a QBL under the banking agency rules. Remember, since 1994, QBLs for banks have been exempt from appraisals if they're under $1 million. Thus, only about 9% of commercial real estate loan volume would be incrementally exempt in comparison to the other banking agency rules. So almost 90% of CRE loan amounts would still require appraisals, despite 2/3 of the transactions being exempted from appraisals. Even if you remove very large commercial real estate transactions from consideration, we estimate that the number of exempted transactions would remain at 2/3, but 3/4 of transaction dollars would still be subject to appraisals. These figures support our conclusion that raising the threshold provides meaningful relief without compromising safety and soundness. We believe that raising the threshold to $1 million would only add marginal risk to the credit union system and the share insurance fund. Commercial real estate currently only makes up about 4% of credit union assets. As noted earlier, and based on CoStar data, we estimate that between 75% to 90% of outstanding commercial real estate balances would not be exempt from appraisal requirements. That leaves only 10 to 25% of the balances that would be exempt. If we take the upper range of 25% and apply it to credit union CRE assets of 4%, we get about 1% of credit union assets where written estimates of market value would be allowed in lieu of an appraisal. Since commercial real estate loans of less than $250,000 are already exempt, the rule is only newly exempting a small fraction, less than 1%, of assets in the credit union system. And for prudent lending reasons, credit unions will still choose to get appraisals on some of these loans. To take it a step further, the degree of residual risk is a function of the transaction exposure, less than 1% of assets in the system. The potential difference in property valuation between an appraisal and written estimate of market value, if any, and the fact that valuations, whether derived from an appraisal or written estimate of market value, become less meaningful over time. If you want to then compare the difference in risk relative to the standards banks are subject to, you also would need to account for QBLs under 1 million and non-QBLs between 500,000 and $1 million. For all these reasons, we do not believe that the final rule creates undue risk. The increased threshold would no longer put credit unions at a competitive disadvantage. It will provide them with relief and flexibility to manage their commercial real estate lending programs. I will turn it over to Larry now for the request.
Thank you, Lou. We request the board approve the final rule. If the board approves this rule, the rule will take effect 90 days after publication in the Federal Register. Staff will also update policies, procedures, and training. With that, we'd be happy to take any questions that you have at this time.
Great. Well, first of all, I want to thank you all for your presentation this morning and for all the hard work that you've done in preparing this final rule. I am mindful of how this rule seeks to add measured flexibility to the threshold for commercial property appraisals in a way that could safely boost credit union member business lending in some of our country's underserved, hard-oppressed, and rural areas. And as I've said repeatedly, the core mission of our agency is to maintain a safe and sound credit union system and to be good stewards of the National Credit Union Share Insurance Fund. At the same time, we must search for ways to rebalance regulation. In this instance, we are looking at a regulation that stands in the way of productive borrowing and lending to credit union members, especially those in underserved areas and rural communities. I want our regulations to be effective, but not excessive. And this rule is consistent with that philosophy. That is why I will be supporting this action today. This is a common sense reform because it allows credit unions to safely provide more members, especially small business owners, with lower cost loans or more quickly turning them around. This will allow for more of these kinds of loans, which will help spur economic growth, job creation, and prosperity, especially for communities that need it most. This change will help credit unions engage in commercial real estate lending, especially for those lending in underserved and rural areas. I should add that the existing threshold of $250,000 has been in place since 2002, and after 20 years, it needs to be updated. There are areas in the country that experience a scarcity of certified property appraisers. For example, some communities in the rural Midwest don't have a sufficient number of appraisers, which means the process of getting a loan to buy commercial property can get extended by many weeks to enable time for a certified appraiser from another region to travel to the borrower's location and provide the necessary physical inspection and estimate the property's value. I know that a lot of comparative analysis and due diligence has been conducted by staff to determine if raising the appraisal threshold represents an undue risk to the credit union lenders and the Share Insurance Fund. Let me be clear. Establishing a new threshold of $1 million does not. If this regulation raised safety and soundness concerns, I would not move forward with it today, and it simply wouldn't be on our agenda. I want to clearly state that this change will only apply to commercial real estate, not residential transactions. Second, this only applies to real estate transactions, not to loans for other types of business assets. We must remember commercial lending represents a relatively small portion of credit union assets, so these loans are likely not to be a source of undue risk to the Share Insurance Fund. Moreover, credit unions will still be responsible for adhering to the appropriate risk management practices for underwriting commercial real estate loans, including the use of written estimates of the property value conducted by a qualified person independent of the transaction, such as a licensed appraiser. That's a critically important part of keeping faith with the borrowers, members, and the communities these institutions serve. I want to say again that when we deliberate on a regulatory reform of this nature, we must be judicious, and we have been. We have taken great care over the last year to listen to both the supporters of raising the appraisal threshold and to the critics. We considered their perspectives and weighed their concerns carefully in constructing this rule. I am confident that this final regulation is indeed prudent and that it will facilitate lending while ensuring the safety and soundness of our credit unions. I now have a few quick questions. Larry, you've indicated this commercial appraisal threshold change only results in small incremental risk to the credit union system and the share insurance fund, in part due to other regulatory and supervisory mitigations. Please summarize your analysis of the risk and discuss any additional supervisory changes we could implement.
Sure. And as both you and Lou noted, the level of activity in this area is pretty low. Lou walked through an analysis that showed that the net transaction risk that we're talking about that wouldn't be subject to appraisal in terms of the incremental change here is a fraction of 1% of assets in the system. We also note that those transactions would be subject to a written estimate of market value requirement that has to be conducted by a qualified individual independent of the transaction and the lending process, collection process in the credit union. We've heightened those standards in the regulation with this final rule. And we would also point out that the December 2nd, 2010 interagency appraisal and evaluation guidelines that establish safety and soundness expectations for prudent appraisal and evaluation policies, procedures, and practices is still in force, and we are a signatory on that. I would also point out that we have another rule, our commercial loan rule, Part 723, right next to the Part 722 we're acting on here today, that deals with commercial lending expectations and requirements for cranes in general. And that rule does require the crane to use collateral valuation methods that are appropriate for the particular type of collateral. And specifically, it states the current collateral value must be established by prudent and accepted commercial lending practices and comply with all regulatory requirements. I would also reemphasize what Lou talked about in terms of underwriting. Our commercial loan rule, Part 723, requires the credit union to use sound underwriting approaches to commercial lending, including analysis of the cash flows, analysis of the borrower's ability to service the debt. And those standards will apply to these types of transactions as well. And cranes have actually done very well over time, with a few exceptions in this area. You noted that threshold of 250,000 has been in place for almost 20 years. Even on an inflation-adjusted basis, that would speak to a number over $500,000 in terms of updating that. And so a lot of the change here can be accounted just for inflation. So that's why we conclude that this is a relatively small incremental risk to cranes in the insurance fund. Do need to be mindful that there is a small subset of credit unions that have significant exposure in commercial real estate relative to their individual size and capital, and the individual asset size of the crane and their capital. And as you know, one of the agency's top supervisory priorities is putting in place new exam and supervisory procedures and priorities for addressing credit concentration risk. And so we will be doing that by the end of the year, and that will have increased scrutiny over those institutions with material levels of any type of credit concentration risk, including commercial real estate.
Great, thank you. And I have a few more questions. What was the role of appraisals in the last recession, and is this rule consistent with lessons learned in the last recession?
Yes, this rule combined again with our new commercial loan rule, Part 723, that was implemented in January of 2017, incorporate the lessons learned from the last recession. The Great Recession was primarily precipitated by problems with residential real estate lending. And the real underlying problem was unsafe and unsound lending practices, in particular lack of prudent underwriting regarding ability to repay and creditworthiness. Given appraisals of value are heavily influenced by recent sales values of comparable properties, when home prices are appreciating, appraisal values will increase as well. This doesn't mean there were necessarily problems with appraisals, it's just the way it works. Also, our analysis of supervisory information for losses on commercial real estate transactions in the last 3 decades indicates that faulty valuations of the underlying real estate collateral have not been a material cause of losses. I would note that, again, that cranes also did relatively well. Cranes that were involved in commercial real estate lending did very well during the crisis, with a few exceptions. Our level of loan losses on that part of the portfolio were less than half of what the banks experienced during the recession.
Great. I just want to confirm that this rule only applies to real property. That is real estate. It does not apply to other forms of collateral for business loans. What is the agency's requirement for business loans secured by other forms of collateral?
That's correct. This rule only applies to real property. Title 11 only governs appraisals for real estate-related financial transactions. Title 11 defines a real estate-related financial transaction as any transaction that involves 1, the sale, lease, purchase, investment in, or exchange of real property, including interest in property or financing thereof; 2, the refinancing of real property or interest in real property; and 3, the use of real property or interest in real property as security for a loan or investment, including mortgage-backed securities. Part 722 of NCUA's regulations implements the Title 11 appraisal requirements and only applies to real estate-related financial transactions, which are defined as Title 11 defines them, that is, in the context of real property only. For other forms of collateral for commercial loans, the NCUA's Commercial Loan Rule, Part 723, requires credit unions to use collateral valuation methods that are appropriate for the particular type of collateral. Specifically, the rule states that the current collateral value must be established by prudent and accepted commercial lending practices and comply with all regulatory requirements.
Great, thank you. And I just have one final question. Do you think this rule will have a significant impact on borrowers and the overall commercial real estate market?
Well, so total commercial real estate loans made by cranes represent only 2.7% of all commercial real estate lending done by all federal insured cranes, which are federal insured institutions, which include banks. So it's a very small portion in total of that space to begin with. And then, as Lou noted, we estimate somewhere between 75% and 90% of that dollar volume would still be subject to an appraisal requirement. And so now you're talking a fraction of that 2.7% that would not. And so, no, we don't think that the change would have a material impact on the overall market. With respect to borrowers, as you've noted, the change is expected to enable credit unions to safely, and when in the best interests of their member owners, provide more borrowers, in particular small businesses, with lower costs and quicker turnaround times for commercial property loans, especially in underserved rural areas. And I would also point out the rule does increase the standards for who can conduct a written estimate, qualifications, and independence, and what goes into a written estimate. So it heightens those standards, and the cranes are responsible for adhering to those standards as well as prudent risk management practices, and we think that this provides adequate protection for the borrower as well.
Great, thank you all. Board Member Harper, you're recognized.
Thank you, Mr. Chairman, and thank you, Rachel, Larry, and Lou, for your hard work on this issue. Like almost everyone else in this room, I lived through the Great Recession, and I remember the destruction and pain that it created for millions of American families, tens of thousands of small businesses, and for thousands of insured depository institutions. Inaccurate and deliberately misleading appraisals and evaluations also contributed to that debacle. And while residential loans were the principal problem of not commercial real estate could become the major problem during the next downturn, just as it was in the 1980s. Key provisions within the Dodd-Frank Act set forth new rules for real estate appraisals and appraisal oversight. As a staff member of the House Financial Services Committee at the time, I devoted considerable efforts on these issues. I am therefore very familiar, perhaps too familiar, with appraisal policy issues. As such, I can say that there are a number of things in this rule that I approve of, such as the restructuring the rule to make it easier to understand what is required and incorporating into the rule the exemption for rural areas provided under S2155, the Economic Growth, Regulatory Relief, and Consumer Protection Act. But I cannot support this rule for three main reasons. First, the magnitude of the increases in the appraisal thresholds is too large in my view. Second, the lack of consistency with rules issued by other federal financial institutions regulators. We have an inconsistency with this rule and the possibility that could create for regulatory arbitrage. And finally, the impact that this rule ultimately may have on important consumer protection safeguards for small business owners, particularly unsophisticated consumers of modest means, and on the safety and soundness of individual credit unions. This rule quadruples the threshold for a certified appraisal of commercial real estate loans made by a credit union from $250,000 to $1 million. It raises the threshold for both the qualified business loan, where the comparable threshold for commercial banks has long been at $1 million, and for the non-QBL loans, where the threshold for commercial banks was only raised last year, as you pointed out, from $250,000 to $500,000, half the threshold proposed in this rule that we have before us today. There's an old adage that says you must learn to crawl before you walk and learn to walk before you run. While with this rule, we're not just running before we walk, we're actually leapfrogging over the other federal financial institutions regulators. Additionally, as Lou pointed out, using data from the CoStar group, the NCUA staff has estimated that under this rule, the percentage of exempted transactions will more than double from 27% to 66%. The percentage of the real estate market dollars exempted is estimated to increase from 1.8% to 13%. To be fair, and as you pointed out, you've also noted that the commercial real estate is only 4% of the credit union assets, that the majority of the 4% is already exempt, and the commercial loans and commercial real estate are a much larger percentage of banks and thrifts balance sheets than it is of credit unions, as well as a much larger percentage of capital. But we don't know that that will always be the case. And one of the reasons the old adage tells us that we should learn to walk before we run is to reduce the risk of falling and failing. In general, banks have a longer history of making commercial real estate loans, and they have larger staffs and more expertise in this area. They are already walking, if not running. And today, nearly half of federally insured credit unions are not subject to the member business lending cap. And as these uncapped credit unions gain greater experience in commercial real estate, they may increase their risk appetites and the system's exposure to commercial real estate losses. While an increase in our existing $250,000 threshold may be justified at this time, it would have been, in my view, more prudent to remove in a smaller incremental step. In reading the comments of the proposed rule, the letter of the CU Business Group stood out. CUBG expressed the opinion that this rule goes too far. They said, quote, "After years of fighting to obtain parity with other financial institutions, credit unions finally made great strides with the 2016 revision to Part 723, which, as you pointed out, is the member business lending rule, and commercial rule, I should add to that. It would be unfortunate," continuing the quote, "for this transaction to be reversed with the creation of a new inequity that could start another round of political turmoil at other financial institutions. The data in the proposed rule shows that the proposed revision will have a positive impact on the number of transactions that will be affected by the change. However, CUBG does not believe the number of loans impacted is the best measurement. Based on our experience and the opinion of our several of our credit unions, a $1 million appraisal threshold for commercial real estate investment property loans is too high. While $1 million would be considered a small loan in markets like Southern California and New York, it would be a sizable loan in other markets where $1 million could represent a significant exposure if the property value is not properly supported by an appraisal. CUBG believes that a $500,000 threshold granted to banks would also be the most appropriate threshold for credit unions. In deliberating with me on this rulemaking, staff has asserted that non-QBL loans are not necessarily more risky than QBL loans to justify the size of the increase. I appreciate that perspective, but I would have been more persuaded if we had data demonstrating that the non-QBL loans have similar or better delinquency rates and charge-off rates than QBLs. It also seems to me to be counterintuitive that we should quadruple the non-QBL threshold as we approach what is more likely to be the end of a decade-long upward economic cycle than the beginning. To be prepared for the next downturn, we should be forward-looking by strengthening our supervisory stance, not loosening it. My second major concern is that this rule is inconsistent with the thresholds adopted by other federal banking regulators. I raised this point when answering a question during my recent confirmation hearing. To prevent a race to the bottom, Congress created the Federal Financial Institutions Examination Council to foster cooperation, collaboration, and consistency among federal financial institutions regulators. As such, the FFIEC works to promote uniformity by issuing and maintaining uniform principles and standards for the examination and supervision of financial institutions. Therefore, Larry, my question for you is whether we were invited to be part of the other agencies' prior rulemakings in this area, especially the non-QBL appraisal threshold final rule, and if not, why not? And if so, why we declined to join them?
Well, I would first start by pointing out that our rule has varied from theirs for some time.
Understood.
And so while we were loosely involved, I think we've had a history of the banking agencies working together on their rule, and we work on ours. And so we coordinate, but we weren't necessarily invited into the engineering phase of their rule change that was finalized in 2018. Similarly, we kept them informed of what we were planning to do. We actually met with them in advance of the board voting on the proposal for this rule in September of 2018. We met with them in advance and briefed them on what they were doing. So we do coordinate, but wasn't joint engineering to my knowledge on their rule and our rule.
Thank you for those insights, Larry. They're very helpful. By leapfrogging the other regulators on the threshold for non-QBL loans, we raise the risk of potential regulatory arbitrage, in my view. We invite people who have loans that might not pass muster with a certified appraiser in a bank transaction to bring them to a credit union where only a written estimate is performed. I know that many people contend that a written estimate can be just as rigorous as a certified appraisal, and I will concede that it can, but it doesn't have to be. The standards for written estimates are significantly different than those for certified appraisals, and the statutory independent standards for certified appraisals are much stronger in my view. Therefore, there is a higher degree of certainty that a certified appraiser is offering a truly independent analysis. That's why the marketplace often mandates certified appraisals even when they are not required by law or regulation. It is also why it is significant that the National Association of Realtors expressed concerns about raising the threshold for certified appraisals in its comment letter on this rulemaking. I expected that credit unions and their trade associations would support raising the threshold, and that banks and appraisers and their trade groups would oppose raising the threshold. But it is significant to me that the realtors who want to get a real estate transaction done in order to get paid said, quote, removing the appraisal element when it could be the most reliable factor in evaluating a transaction is concerning, unquote. I should also note that for the record, it wasn't just the realtors who were concerned about the increase in the threshold. More than 3/4 of the comments we received on this issue opposed raising the threshold to $1 million. My third and final concern with this final rule is the impact the change may have on individual credit union members and an individual credit union itself. Certified appraisals are done to protect both the credit union members and their credit unions. They are an essential element of consumer protection, in my view. While the recent problems in the taxi medallion lending had many different attributes from commercial real estate lending, they also had some similarities. Like taxi medallion loans, non-QBL loans of less than $1 million are often made to relatively unsophisticated buyers. We have seen the hardships that were created when the credit union members are allowed to get in over their heads. A certified appraisal, in my view, is a more important consumer safeguard designed to protect relatively inexperienced borrowers. We also know that even though it is a different type of commercial loan, the amount of the average taxi medallion loan was less than the $1 million threshold proposed in this rule. Loans of this size can destroy the finances and lives of individual credit union members, as we saw after the taxi medallion meltdown. Furthermore, the experiences of the Great Recession also demonstrate that when the same mistake is repeated many times, even for relatively small loans, it can have a dramatic impact on both individual borrowers and individual financial institutions. In response to the Great Recession, Congress required the Government Accountability Office to study the issue of appraisals. The 2012 report of the GAO in this area noted that appraisals play a critical role in underwriting by providing evidence that the market value of a property is sufficient to help mitigate losses if a borrower is unable to repay the loan. That same report also documented how many small loans without appraisals can create a virtual house of cards. We should heed that advice today when considering this rule. Therefore, in conclusion, the magnitude of this loan increase in the thresholds at this point in this economic cycle, combined with the inconsistency they create with the thresholds adopted by other federal financial institutions regulators, and our need to prioritize both safety and soundness and provide consumer protection to persons of modest means, compel me to oppose this rule at this time. Accordingly, I will vote nay on this matter.
Thank you, Mr. Harper. Board Member McWaters, you're recognized.
Thank you. Mr. Fazio, just a quick comment on taxis. It's my understanding that in 2015, when the taxi medallion bubble burst, that the average taxi medallion loan by a credit union was around $320,000. Is that correct?
Yes.
Okay, so with that number of an average loan of $320,000, that's below the 500 that the banks have currently for non-QBLs, correct?
Yes.
And if a taxi medallion loan was a functional equivalent of a QBL, then under the bank rules, if they were to apply, if we were to adopt those, that would be $1 million, which is well above the average of 320 or so.
Yes. And the QBL threshold of $1 million has been in place since 1994.
So it's been around a long time when credit unions have not had the benefit of that.
Correct.
Okay. Now, in fairness, the 320 or so average in 2015, that's an average. There were some that were higher, much higher, and there were some that were lower, much lower, but the average was around 320. So even if an appraisal rule had applied at that time, the average loan under this structure, let's say adopted by the banking agencies, it would have been exempted, regardless of whether a taxi medallion loan was considered a QBL or a non-QBL.
Yes, a large percentage of the loans would have been exempt from appraisal requirements under the bank if they were subject to the bank rule. In two respects. One, they were a bank that was subject to the rule, and to Rachel's point, appraisal standards for NCUA and for the banking regulators apply to real property, not
Yes.
to that type of collateral.
Yes.
So this is a hypothetical
This is
discussion.
totally hypothetical.
Just to be clear.
This is totally hypothetical. I get that.
And I would also note that depending on the way that the business owner was using the taxi medallion, if it was an owner-operator, it would be more analogous to a QBL. If it was a fleet owner that was leasing it out, it would be a non-QBL. So, again, in this hypothetical argument.
Okay, so the owner-operator is much more likely to be the little guy, right?
Correct.
Okay, the little guy that has one medallion, and if that's considered a QBL equivalent, under a rule like this, if this rule applied to tax medallions, which it doesn't, then there would be no appraisal requirement.
That's my understanding.
Okay.
I just want to make one clarification too. With the statistic we're using, the 320 average, that's per medallion. Some loans had a higher loan balance, but they were backed by multiple medallions.
Yes.
So
Yes.
just to be clear.
Since I've been at the NCUA, I've had a regulatory philosophy. The regulation should be tailored and targeted to the risk presented, the actual risk presented, and with the idea that, whatever we do has to protect safety and soundness. So let's target to the actual risk presented, but let's be careful. Always keep in mind safety and soundness. In other words, my view, and I've said this in speeches before, is that what we should be doing is using Obi-Wan's lightsaber and not Vader's Death Star. Because if you use Vader's Death Star, it's very, very effective. We've seen that, right? But it's not very efficient. There's a lot of collateral damage. There's a lot of unintended consequences. So I take that approach. So when I look at this rule, I ask myself, is this rule tailored and targeted to the risk presented, and does it present a safety and soundness issue? Well, it's tailored and targeted. It only affects commercial real estate of a certain dollar amount between $250 and $1 million. And if you use the banking rule as sort of a guidepost, then it's really only between 500,000 and 1 million. So I think it's pretty tailored, pretty targeted. Now, does it present a risk? Let's go to slide 9. So commercial real estate of all credit unions is 4% of assets. That's a pretty small number, but if you go down to the very bottom of that inverted triangle there, it says the commercial real estate transactions that are not covered by one of these certified appraisals is less than 1% of credit union assets. So it's almost by definition, I don't have a safety and soundness issue here. It's less than 1% of credit union assets. And some may argue, well, these people may decide to lever up and start doing a lot of loans between $500,000 and $1 million because they can save $400 on an appraisal. I don't personally see that happening, but if it did happen. Aren't there limitations on our ability or credit unions' ability to make commercial loans?
So there's a statutory cap on business lending, but to be clear, if a credit union is low income designated or was chartered for the purpose of making business loans or has a history of primarily making business loans, they're exempt from the cap. That's about half of the institutions in total. So half of the institutions aren't subject to the statutory cap, but the other half are.
Okay, so there is some limitation. There also may be the other limitation that perhaps more low-income credit unions serve their individual members that are not necessarily in the real estate, the financing development side of the equation.
Yeah, there's obviously a lot of cranes that aren't involved in commercial real estate to begin with. The other point I would make, we have another regulatory limit in the business loan rule, Part 723, that a credit union can't expose more than 15% of its net worth to a single borrower or a group of associated borrowers. So practically speaking, credit unions less than 30 million in assets couldn't even get up to 500,000 in a loan.
Okay, so you have a loan limit per borrower limit.
Right.
Then you have an MBL limit on top of that. Then you just have a history of basically not occupying much room in this space.
Right. And to get all the way to the million, you'd have to be at least on average 60 million. A credit would have to be on average about 60 million in assets. So 30 million, credits that are less than 30 million in assets make up half of all credit unions. And credits less than 60 million in assets make up about what, 70%, no, 62%. So a good chunk of the crane space either can't take advantage of this new limit or can't take full advantage of it.
Okay, I mean,
because of that other regulatory constraint.
Okay, I mean the point has been made today, but I think by all three of us that we're an independent agency. Yet there is some concern that we look at this rule in light of what the banking regulators are also doing, and I agree with that. So I looked to the top of 9 and saw 4% of credit union assets, commercial real estate. And I asked a couple questions. What if that was all banks? Commercial real estate equals what percent of bank assets, all bank assets? And I got a number of around 13%. Okay, so all banks, 13% of their assets are commercial real estate. Then I thought about, well, what compares most to credit unions? It's community banks. And so commercial real estate equals about 35% of community bank assets. 35% versus 4%, 13% versus 4%. So I thought that rationally and logically, if I was a bank regulator, which I'm not, then I would look at that risk. Wait a minute, every community bank has over a third of their assets in commercial real estate. I'm going to be very, very careful. with commercial real estate because of the concentration risk in commercial real estate. The concentration risk on credit unions is very, very small. So the rule is tailored, is targeted to the risk presented, the actual risk presented. I don't see a safety and soundness issue here at all. Also, I think it's worth saying that sometimes people, they glom onto this word appraisal, and they think, oh my gosh, if I have an appraisal, it's like a guarantee, right? Oh, if I have a certified appraisal, then I'm good. This loan is good. It's always going to be paid back if someone signed it and they went to the proper education and they followed the proper methodology, and this is the value. That's not it. It's an estimate at a point in time, or a range in estimates of a point in time of the value of a piece of property. It's not, I guarantee this to be the value. So when I was practicing law, I did various commercial credits representing financial institutions and making loans either to purchase office buildings, groups of apartment complexes, or maybe facilities where plants are located, where widgets are made, or whatever. And in doing all of those, from an underwriting perspective, from a proper underwriting perspective, your first thing is, will that office building generate enough cash flow to service the debt? Now, in making that determination, you don't assume pie in the sky numbers. You don't assume 100% occupancy and rental rates that go up at 15% a year. If you do, your loan is going to blow up. So you look at what's reasonable, then you shock it. You create a bell curve around it. What if occupancy drops from 85% to 70%? What if it bumps up? What if rental rates drop down? You do that because what you're trying to do is ask yourself the fundamental question: the value of any piece of real estate, other than a home, a residence, is the discounted present value and a risk-adjusted rate of the cash flow generated from that building. You have to do that. And I think what you said, Mr. Fazio, is in our rules, separate and apart from an appraisal requirement. All credit unions are required to do that. We're not loosening that up. We're not saying, oh, don't pay attention to cash flow. So we have the cash flow analysis. Also, you look at the loan papers themselves, the representations, their warranties. There's positive covenants or affirmative covenants, negative covenants, financial covenants. There's indemnities. There's guarantees. There's all kinds of other things out there to support this. So when I look at appraisals, I'm a little bit jaundiced. Maybe I've been at this too long and I've seen too many downturns. But the key is, will your property generate the cash flow that's necessary to pay it back? That's what is going to make it. If your apartment complex blows up, plant is outsourced or whatever, then you look to the disposition of the actual real estate itself. The problem is that when that happens, it's a few years later and your appraisal is as of a certain date and time. And now the world has changed. It's not worth what the appraisal said, because the appraisal had certain assumptions. It's assuming things like it will be occupied by this manufacturing company, or it will be 85% full of tenants paying a market rate of interest. If that no longer happens, your appraisal is absolutely worth nothing. So I think that to me, the takeaway point, this rule is reasonable, but nonetheless, in implementing this rule, we as an agency, you as head of examinations, we need to be careful and thoughtful and mindful that credit unions, when they're making these loans, are doing the proper analysis. In addition to this, estimated value and stuff like that, they're doing the proper cash flow analysis. Their documents have the proper terms in it and get a guarantee when they get it. They pledge other collateral when they can. Then I'm less worried. If we let that slip, appraisals are not going to save us. So we have to remain mindful of the cash flow. Thank you.
Great, thank you. Is there a motion?
Somewhere. I move the board approve final rule part 722 of NCUA's rules and regulations as attached to the board action memorandum.
Is there a second to the motion? Hearing none, I second the motion. All in favor, say aye.
Aye.
All opposed, say nay.
Nay.
Let the record show the motion passed 2-1. Thank you all. Tomorrow, ladies and gentlemen, NCUA will say goodbye to Mike Radway, who was Senior Policy Advisor to Board Member Harper. Mike is retiring after more than 5 years at NCUA. Prior to joining the NCUA, Mike spent 22 years on Capitol Hill working on financial services issues. Mike, we wish you the best in your retirement as you move back to Oregon. I would now like to recognize Board Member Harper to honor Mike's service.
Thank you, Mr. Chairman, for those warm words about Mike Radway. They are very much appreciated. Many in this room may not know it, but this is actually the third time that I've had the pleasure of working with Mike. We first worked together in Congressman Konjorski's office in the 1990s, and later we worked together here at the NCUA when Mike came to work for former board member Rick Metzger. And I had the pleasure of working with Mike for a third time when he agreed to delay his retirement and serve as my initial senior policy advisor after I joined the NCUA board. It was also Mike Radway's decisions to get some sleep and get married that led me to occupy this seat in this room today. Let me explain. We all know that Mike is a tireless advocate for credit unions, that is, except for one occasion. While he was Congressman Konjorski's legislative director, and Congressman Konjorski was the lead sponsor of H.R. 1151, the Credit Union Membership Access Act, Mike was intimately involved in the negotiations over the content of that landmark legislation, as well as the timing of its consideration. Initially, the House had wanted to use the Credit Union Membership Access Act as the engine for passing the bill that would one day become the Gramm-Leach-Bliley Act. But Mike was canny enough to know that if the two bills were linked together, the path to enactment would slow tremendously. And because of the Supreme Court's ruling, there was an urgent need to enact 1151 as quickly as possible. So Mike worked without sleep over 2 days to educate lawmakers about why the Credit Union Membership Access Act needed to move on a separate track. His hard work paid off. After the House leadership abandoned plans to bring a combined bill to the House floor, Mike went home to get some well-deserved sleep. And about 2 hours later, the House leadership announced that it would bring a standalone credit union bill to the House floor the very next day. In the days before Blackberries and smartphones, we tried to reach Mike, but we couldn't manage to wake him. So I had to write the Dear Colleague letter explaining why lawmakers should support the Credit Union Membership Access Act. Thank you, Mike, for getting some sleep and forcing me to take a crash course in credit union policy issues. A short time later, Mike decided to move to the West Coast to marry his fiancée, Stephanie Vardavis, and I was asked to become Congressman Konjorski's legislative director, which led me to develop an expertise on financial services issues. Fast forward 2 decades, and I can honestly say that I am where I am today because of Mike Radway's well-deserved rest and decision to get married. I can also say that I know of few people who are as creative in considering policy issues as Mike. His mind never stops working, and he is always looking for a way to find common ground. As a result, I will greatly miss working with him. I will also miss his encyclopedic, vast, and comprehensive knowledge of financial services issues, especially those in the credit union space. Further, Mike taught me about the importance of learning to pay attention to the details. He also taught me how to put together a statement that would get quoted and remembered. Mike, I can't thank you enough for all that you have done over the years, and I ask that everyone in this room join me in congratulating you in your well-deserved retirement. We hope that it is long, prosperous, adventurous, healthful, and joyful, and we wish you and Stephanie all the very best for many, many years to come.
Well said. Well said. Thank you, Board Member Harper. That was wonderfully said. I'd now like to recognize Mr. McWaters, who would also like to honor Mike.
Mike, it's been a pleasure to get to know you. I mean, some people, wonder about, what we do on the NCUA board, how the sausage is made. Well, the sausage is made with people talking to people. It's communication, it's negotiation. I had a no-fly zone around board member, former chair Rick Metzger. I couldn't really deal with him directly on credit union issues. So I had to deal with Mike. Now, Sarah Vega, my then chief of staff, could deal with Mike and Rick, but I was limited to Mike. And what a pleasure it's been over the years to do that. Why? He's collegial. He's fair-minded. He's collaborative. It doesn't mean you agree on everything. But if you approach things understanding that reasonable minds may differ and that you're going to listen to principled arguments, even though you may say, I prefer another one, Mike was that kind of guy. Mike is that kind of guy. And without him, I dare say, a lot of the bipartisanship, a lot of what we have done over the last 3 years would not have been accomplished. So thank you, Mike. It's been a pleasure, honor to work with you. Thank you.
Thank you. Again, we honor you, Mike, graduating your service. Well, ladies and gentlemen, I would be remiss if we did not recognize the remarkable service of one of NCUA's longest tenured employees who will be retiring from the agency next month, Hattie Ulan. Hattie, I think I saw you earlier. Well, we're going to recognize you as well. Hattie started her career at the NCUA's Office of General Counsel in 1983 and quickly became a mainstay through her outstanding contributions. Hattie was instrumental during my Senate confirmations in both 2005 and in 2019. Since joining the NCUA, Hattie has served in many other important positions, including Associate General Counsel, Special Counsel to the General Counsel, and Acting Secretary for the NCUA Board. Perhaps even more than all of her professional accomplishments, her NCUA colleagues know Hattie for her thoughtfulness and kindness. She will be greatly missed by the entire NCUA team, and we wish her and her family all the best in her retirement. Hattie, please stand again so we can applaud you, because that was more of a... I speak for this entire board and all of the NCUA in saying that you will be deeply missed. We wish you all the best. And now I'd like to turn the mic over to Board Member Harper to also make a few comments about Hattie.
First of all, you said it all so well about Hattie. I, too, would have not gotten through the confirmation process, but for Hattie paying attention to all of the details down to the penny. I might add on my financial statements, as well as giving me very great advice about how to answer some of the thornier questions that are asked of every nominee in the process. I thank you for that, Hattie. I also thank you for your friendship over the years. You and I have gotten to know each other in a way outside of the NCUA. And I think that all that you have done and all that you aspire to help and make the world a better place has made NCUA a better place. So thank you for that.
Thank you. And Board Member Waters.
With respect to Hattie, I guess I can offer about as high of a compliment as I can offer, in that, to me, Hattie is a lawyer's lawyer, meaning that she's not flustered. She doesn't lose her cool. She keeps somewhat of a sense of humor about things. She's extraordinarily discreet, and it's been a pleasure, because when I dealt with her over the years, I knew I was getting good law, straight up, understandable answer. If I didn't understand it, she would explain it again. Sooner or later, it'll trickle down to me, and I'll pick up on it. And I will miss you, Hattie. I will miss working with you around here. I will miss knowing, oh God, I got to talk to Hattie about this, and then realizing Hattie's not around. So thank you, Hattie. Thank you for your service. Thank you for everything you have done for this agency, this board, And from me, thank you.
Thank you. This is the end of our agenda today. We will not be meeting in August, but so we will see you again in September. With that being said, I hope you all have a wonderful remainder of the summer with your families. We wish you great safety. We hope you have a relaxing time. Those of you here at the agency, please take the well-deserved time you need to take off and recharge batteries, as approved by those who approve your vacations and things like that.
Yeah.
But at the end of the day, I just want you all to be well, be careful, and I look forward to seeing you in September. There being no other business, I adjourn the meeting. Thank you. And what